You perform a Roth conversion today. How long does it take to break even on that Roth conversion? Does it take 1 year, 10 years, 20 years? I receive this question all the time, and it's obviously a very important question that we need to understand inside of our tax plan. But if you're thinking about a Roth conversion break even in terms of time, you're thinking about this all wrong, because a Roth conversion break even has nothing to do with time. It has everything to do with this. Here's how I find most people think about the break even on a Roth conversion. So let's say we have a simple tax deferred account like a 401k. We know that anytime we withdraw money, income from that 401k, we are going to owe taxes. Well, if we perform a Roth conversion, we're essentially paying taxes on that amount today. We're putting it in a Roth IRA, and regardless of how big that Roth IRA grows, we're never going to owe taxes on that amount again. So let's say we are going to convert $100,000 from that 401k. Taxes are going to be $20,000 for that given conversion, let's say. Well, on paper, we just took a tax hit by performing that Roth conversion. On paper, we have less money in the account. So how long will it take for these two to converge in time and for the Roth conversion to start making sense? Now, this is the exact wrong way to look at a Roth conversion break even, because there will never be a break even under this idea. It doesn't matter what we earn as a growth rate. It doesn't matter how long we wait. There will never be a break even. Let's take these two scenarios, this 401k and Roth conversion, and let's grow these two at 6% per year as a growth rate for 20 years. Well, in this scenario, we see that the Roth conversion loses by around $65,000. Let's take another scenario. Let's grow these two accounts by 10% per year for 30 years this time. Well, now the Roth conversion loses by $350,000. These two lines will never converge because this is not the right way to look at a Roth conversion at all. As soon as we perform that conversion, we take that tax hit, it looks like the Roth conversion is now losing. But that's only because we're looking at a pre-tax number versus an after-tax number. You see, the number on the paper for your tax-deferred account is really a mirage. It's a pre-tax number. The only way we will receive benefits from that tax-deferred account, that 401k, is if we withdraw income from that account. Well, withdrawing income, we will owe a tax rate. Now, for the sake of this first example here, we're going to withdraw income at a 20% tax rate, the same rate we paid on a Roth conversion. And it doesn't matter when we withdraw that income. It doesn't matter how long we wait to withdraw it. It doesn't matter what growth rate we're looking at. If we're withdrawing at the same rate that we would have been converting at, we will have the same exact ending value. Now, if we pay a tax rate higher than 20% when we withdraw money from that tax-deferred 401k, no matter what way you slice it, the Roth conversion will win. It doesn't matter how long we wait to withdraw that money. It doesn't matter the underlying growth rate. It doesn't matter whether we withdraw it all at once or whether we withdraw it over time. The Roth conversion will win. So this right here is the most important takeaway when considering a Roth conversion break even. It has nothing to do with the amount of time that passes. It has everything to do with the tax rate you are paying on the Roth conversion versus the tax rate you are avoiding in the future. It's all about tax rates. And as a retiree, you need to understand that someone is going to pay that given tax rate. It might be you while you're alive, or it might be your heirs when you pass that on to the next generation. But someone is paying that given tax rate. Again, it's called a tax-deferred account, not a tax avoidance account. Now, as a retiree, there are all of these given tax hurdles that we want to avoid in retirement. These tax hurdles can raise your marginal rate, thus making a Roth conversion right now make more sense. For instance, required minimum distribution, RMDs, are one of the biggest tax hurdles. These start at age 72 and you're forced to take a certain amount of money from your tax-deferred accounts each and every year. Now, depending on how big your tax-deferred accounts are, these RMDs can be one of the most destructive tax hurdles that retirees face. These RMDs can push you up into higher brackets, especially on money that you don't ultimately need. You're simply just paying higher tax rates on those given withdrawals. It can push you into Medicare premium increase zones, thus causing you to owe extra Medicare premiums for Part B as well as Part D. These RMDs can push your tax base up high enough that if you have any long-term capital gains, remember these long-term capital gains are stacked on last, which if you have an RMD pushing those long-term capital gains up into higher brackets, then once again, you're paying higher taxes due to these RMDs. Now you're paying it on something indirectly from those RMDs, but nonetheless, you're paying higher taxes. Another big tax hurdle that retirees should try to avoid is something called the Social Security tax torpedo. Now this is created because your Social Security benefit, how much of that is taxable, is determined by your other taxable income. And so basically what happens here is there's a double taxation zone that retirees need to navigate. As retirees take income from their tax-deferred accounts, it will force more of your Social Security benefit into being taxed. $1 of additional income might force 85 cents of your Social Security benefit to being taxed. Thus, $1 forces $1.85 into being taxed, and we see a spike in marginal rates. But on the break even of a Roth conversion, I'm often asked, well, what happens if I pass away at age 75? Well, then a lot of these tax hurdles I really don't have to worry about because I'm no longer alive. So how does that change my given break even? And yes, you are correct that if you pass away, you no longer have to worry about things like the Social Security tax torpedo. But because you pass away, that doesn't mean that the tax liability on your tax-deferred accounts all of a sudden vanishes. Under the Secure Act that was put into law in 2020, when you pass a tax-deferred account on to the next generation, your heirs have 10 years to fully exhaust that tax-deferred account. Every withdrawal that they take from that tax-deferred account, they will owe a tax rate on. And so this Roth conversion break-even still applies. But again, it has nothing to do with time here. It has everything to do with tax rates. But now things get a little bit more complex because now you're comparing your tax rate at a conversion versus the tax rate that your heirs would be paying as they withdraw that in that 10-year window. Now, in a lot of instances, your heirs' tax rates will likely be higher than what you would prudently be converting at. Now, if we think about this, if you pass away while your heirs are still working, they're earning a base level of income. Now, any withdrawals that they take from that tax-deferred account are going to be stacked on last, which means those tax-deferred withdrawals are going to receive the highest tax rate that they would be subject to. And even if your heirs are retired by the time that you pass away, now they face the same tax hurdles that you are currently facing with RMDs, with the Social Security tax torpedo, with trying to earn a healthcare subsidy, and all of those given dynamics that we have to try to balance. And we also shouldn't assume that your heirs are going to withdraw that money in the most tax-efficient manner. A certain percentage of heirs will withdraw that money in a larger lump sum, thus paying higher tax rates because they want to utilize that in some form or fashion in their life. So when thinking about a Roth conversion, what matters is the tax rate now versus the tax rate in the future. It doesn't matter if that future tax rate is your tax rate or your heirs, the math remains the same. Roth conversion break-even is not a time question, it's a rate question. Now, there is a clarifying point that I want to make sure everyone watching this video understands because it's led to some confusion in the past. So a question that I've gotten in the past is if we're going to perform a Roth conversion of $100,000 and pay 20% as a tax rate, that doesn't really make sense, right? Because I can take that $100,000 and I can withdraw that at lower tax rates, fill up lower brackets at some point in the future. If I withdraw that $100,000 at a later point, aren't I filling in the standard deduction, the 10% bracket, the 12% bracket? So it doesn't make sense to convert at 20% in order to save on taxes at, let's say, 12%, right? And this is correct, but that's not exactly how Roth conversions work, or not how you should utilize a Roth conversion. For instance, you're not performing a Roth conversion in order to eliminate another year's worth of income. With the Roth conversion, you are trying to eliminate the top portion of income you will take in additional years. For instance, if you are trying to lower RMDs in the future, a Roth conversion today will lower your tax-deferred balances. That will then lower the amount that you are forced to take each and every year for the rest of your retirement. And so in conceptual terms, let's say a relatively large Roth conversion eliminates $5,000 in RMDs each and every year. Well, it's eliminating the top portion of that RMD that you were forced to take. Now, the top portion of that RMD is likely to be some of the highest taxed income that you have. Again, because it's being pushed into the highest tax rates. We have a progressive tax system. Now, this concept of how much a given Roth conversion will lower your given RMDs moving into the future is a topic I plan to dive a lot more in-depth into in future videos. Make sure you hit the subscribe button to be notified when that video comes out. So in your tax plan, you absolutely need to be calculating out this Roth conversion break-even correctly. If not, you're essentially flying blind and are likely going to be paying a lot more in taxes than you need to. Remember, the break-even has nothing to do with time and everything to do with tax rates. And so calculating out those given tax rates through time is the whole game. If you're looking for an experienced team to help you design your retirement plan and tax plan, you can find a link to the Safeguard Wealth Management team in the description below. And to add to the complexity of this break-even question, did you know that changes may be coming to change your RMD age? Currently, you're forced to take RMDs at age 72, but this is likely to change in the future, and certain groups of retirees will take RMDs at age 72, 73, 74, and 75. We just recorded a video explaining this exact change, and understanding when your RMD age will be critical to understanding this Roth conversion break even. Thanks for watching, and always remember, you don't need more money, you need a better plan.